For example, the book value is 300, 90% is 270, maybe we paid 300 or 310 or 280. If it is more than 270, there will be an excess. But in this question, chapter 2 and 3, we have no excess, no goodwill, no differential. Whatever the book value, we pay the same amount. Okay? So here, the acquisition price is 270. All right? So what other information we have here? Okay, here are the company's information. So the question here, do the what first of all, equity method entries, journal entries. What are these journal entries? 3. What are they? Acquisition, net income, and dividend. So, do we know acquisition amount? How much they paid? Yes. So the first entry is easy. What do we do? Debit, investment, credit, cash. Here cash, right? Because there is no bonds, debenture, own shares. If it says, be careful. Otherwise, cash. So how much? 270. Very good. The first entry is okay. Debit investments, 270,000. Credit cash, 270,000. Okay. What is second entry? Second entry is about net income. Do we know net income? Net income of subsidiary. Okay, correct. We have to debit, Sarah, investment, credit, income from subsidiary. That's correct, but how much? We have to calculate it, right? So we need to know how much is the net income. So looking at this, we can calculate the net income, can we? Net income of Snoopy. Make it a bit bigger and change the color. Would be better maybe. Okay. Net income of Snoopy. Right? So the net income of Snoopy, we have revenue, right? How much is the revenue? Sure. How much is the revenue? $250. Is that okay? 250. Oh, what happened? Size. Sales. Sales revenue. Let me write sales revenue. Maybe it is better you to understand it. 250, right? Revenue or sales revenue or sales just. Okay? Minus expenses. Minus cost of goods sold. How much is the cost of goods sold? 125. Yes, 125,000. Okay, so gross profit equals to 125,000, okay, minus other expenses. Other expenses here, what are the other expenses? Depreciation and sales and administrative, that is 50. Okay. 225 minus other expenses 40,000. Isn't it 40,000? Do you agree with that? What is that 40? 10, oh, it's not 40. I'm sorry. 50 minus other expenses. It is 50, right? Look, 10,000 depreciation, 40,000 sales administration, that's 50. So net income equals to $75,000. Okay, so we get the net income. Okay, Duha, okay. All right. So, look, 125 cost of goods sold, 10 depreciation, 40 40 is the selling administrative, so 125, 10, 40 altogether 175. 250 minus 175, you get 75, okay? You don't need to prepare this gross margin or other, but just simple, you can calculate it like this, okay? Very simply, you can say that 250,000 of this technology. Net income. Again, I'm writing one more, sorry. Okay, now you can simply do like this. 250,000, you know, okay, minus 125,000 minus 10,000 minus 40,000. Okay, and it equals, sorry? Yes, equals to 75,000. Okay, you can do simple like this. Okay, you can do like this. Yes.
Cost of goods sold plus the gross profit.
Not Did you have cost accounting class?
Yeah.
Yes. Did you have financial accounting class? Yes. So this question is okay. I'm answering that question. Look, in the income statement, sales revenue minus cost of goods sold gives me the gross profit. Gross profit is sub amount. This shows the profitability of the company after the cost of goods sold. Okay, and then we deduct operating expenses, we get operating income. Then we deduct tax and interest, we get net income. But shortly here, the target is not preparing income statement. Here, what we are doing, we are calculating net income, right? So net income, we calculate 75. Just simply, I mean, in the assignment, you don't need to do this. You can just calculate net income is this, because revenue minus all expenses, we get this, 75, that's all. But here, one thing else, what is that? The company have how many percent of this? 90%. So this 75,000 should be multiplied by, yeah, okay. Net income from subsidiary will be okay. Net income from subsidiary will be 90% of this. Okay. Okay. So non-controlling interest in net income of subsidiary, it will be 10% of this. So we have to multiply with 90% and 10%. 90% we will write net income from subsidiary in the parent statement. 10% will be written as non-controlling interest. Okay? So,
Both of company I will multiply.
multiply by 90%.
Okay.
So that will be 67,500.
Okay, what 10%?
10% is non-controlling interest, the other part, remaining part.
Where I will put it?
Okay, where you put it? When you write the basic consolidation entry. Not the equity method entry. Okay? So, equity method entries, okay? What are the equity method entries? First of all, for the acquisition, investment in subsidiary, Snoopy, right? Snoopy, let me write Snoopy. And credit, cash, right? So how much? 270,000. This is the acquisition. Okay? Then second entry. Investment in Snoopy, debit, credit, yes, income from Snoopy. So, when we say the investment from Snoopy, income from Snoopy, remember, with the percentage we are multiplying in the equity method entries in the first assignment also you did it. 90% times 75,000, it is 67,500. Okay? What is this? Equity method entry relating to income. What is the last one? The third one. It is about dividend. Yes. What is the entry? Debit, cash or dividend receivable. Now let's write cash, credit, investment, right? So this is the equity method entries. So how much is the amount? Let's see. How much is the dividend of Snoopy? Exactly. Someone is confusing with 100. No, the dividend declared for Snoopy we are taking. So 20,000, correct? So do we write here 20? Exactly, 90% of the dividend. So I will write here 90% of the dividend. So it will be 18,000, correct? Okay, this is the how we do equity method entries. But we need to know how much is the net income, how much is the dividend. And then, okay, after doing it, now we can prepare the book value calculation table. Okay, book value calculation table. You know, in the book value calculation table, what do we have? In the book value calculation table, we have two sides, right? One side for investment, one side for stockholders' equity of subsidiary. Stockholders' equity means common stock and retained earnings, two accounts. Now, investment has two parts, 90% parent share, 10% non-controlling interest, correct? So, here on the left side, parents 90%, non-controlling 10%. Okay? In the assignment, group assignment, I give this kind of table. It was 70%, I think. This was 70, so non-controlling was 30%. And anything on the right side will be multiplied by 90 and 10 here. So, book value of book value of subsidiary at the date of acquisition. It is 300. At the beginning we discussed about it, right? 200 common stock, 100 retained earnings, total 300. 300 times 90, it is 270. You can see it well, right? It's big enough, okay. So this 30 is a 10%. So this is 300 times 90 and 10. Clear? Beginning balance. At the date of acquisition, it was like this. Then later, at this year, first year, we made a net income of 75. You remember? 75 we calculated, how we calculated that? Yes.
What about the non-controlling?
Non-controlling interest is this. You didn't attend online? I think you didn't even was online. Yeah, I remember. So the thing is here, if you own another companies, not all, but most majority, okay, it means that someone else has this company's some shares, right? For example, here Peanut bought 90% of these shares. Okay, so when you report in your balance sheet, actually 90% of that company is yours. Normally you have your statement and you have take their statement and you combine, right? But when you are combining, you are taking 100% of it. So two company make one statement. If it is 100%, no problem. This is yours, all of them. But if there is 10% non-controlling interest, so it means that whatever they make net income, not 10% is not yours. 90 is yours. When we talk about net asset, 90% of asset is yours, not 10%. So this 10% of income and 10% of net asset should be shown separately in the consolidated statement. Now here, 90% is parent share. So remaining 10. In the assignment, for example, it was 70. It means remaining 30. It should be 100, right? Let's say if it was 60, what is non-controlling interest? If the parent share is 60, what is the share of non-controlling interest? 40. 60, 40. 70, 30. Here 90, 10. Clear? Okay, so we have to report this 10% non-controlling. So here on the left side of this table, we see investment, right? In chapter 2, there was one column. One column, why? 100% was belonging to parent. But now here the investment have two parts. Why? As I told you, that investment actually 90% is parent's share, Peanut's share, but 10% is something else, non-controlling. So we have to separately show this, and then we have to report in the consolidated balance sheet. In basic consolidation entry, I will use this column, information in this column. Okay?
Here we have two shareholders.
Two type of ownership. You have one parent shares, the other, yes.
One have
Yeah, that's the parent that we are making the consolidation.
and one have 10.
10%, yeah, those are others, other than parent. It doesn't matter 1, 2, 3%. It can be 1% to 10 people, doesn't matter, I don't care. I care it is not belonging to parent, the others. Others are non-controlling interests. So that part, other than parent, should be reported as a total, as a one amount. Okay? So, here, you know this table, Noah? This is book value calculation table. Beginning balance plus net income minus dividend, we get ending balance. So how much is the net income here? 75. And what is the 67,500? How did we get this 67,500? Fatma, how did we get? Do you have an opinion? No? I did it at a few minutes ago, you see? Yeah, 90%. Here I did it, do you remember? 90% of 75. And 10% of 75. Okay? So that 10% and 90 is shown here. 90% of 75,000. Yes, Fajr Rashid. Thank you very much. Thank you for contribution. So this 7,500 is the 10% of 75. And then for dividends, Pay, what do you think? How do we get this 18? Do you have opinion? 20,000 is the dividend, right? What is this? 90% of this 20,000. Okay? So this column shows all 90% of this right side. Okay? So this 2,000 is the, if this is 90, this is 10. 10% of what? 20,000. 10% of 20,000 is 2,000. So we multiply 90% and 10% and we wrote them here. And we get this beginning balance plus net income minus dividend. We get the ending balance. And this balance is the what we see in the balance sheet. And also we see in the question. Look at the question. In the trial balance, we have ending balance, right? You see? 319,500. You see? 319,500. Yeah, this is investment. This is investment, parent investment. Actually, normally, 10% also there is some share, but we excluded it. We didn't put in investment. Investment in only 90% of the subsidiaries net income. Okay?
We have the questions 300, which is
This is here. Look, 100 and 200. What is that? Common stock and retained earnings. 200 and 100.
Book value table.
Yes.
We have 270,000 and we have 30. Is it from the questions?
In the assignment?
Here, the question.
In this question, where is 70, 30?
We have
90 and 10.
I know. Down. We have 200 and beginning.
270.
Yes.
Okay. Look, right side, 200 and 100. You see? This is total how much?
300.
Multiply by 90.
270.
Okay? You get it? Oh, what about this 30? 10%. 10% of 300. Okay? So any other question? Is it clear so far? Good. What is next? After book value calculation table, what I will do next? Actually, I need to do consolidation, right? To do this consolidation, we need entries. Now, first entry, basic consolidation entry. Okay? So basic consolidation entry, we eliminate stockholders' equity of subsidiary. We eliminate investment in parent. We eliminate net income and dividend. So to eliminate that, debit common stock, debit retained earnings, debit income from subsidiary, Snoopy. But also we have another income now, non-controlling interest in net income. So when we are eliminating income, we have to eliminate non-controlling share as well. Credit, dividends. Credit, investment. And when we are eliminating investment, we also credit non-controlling interest in net assets. Okay, so the equity method entry here, debit common stock 200, debit retained earnings 100, debit income from Snoopy, debit 7,500. What is this initials? Yes, Dalal, what is this initials? non-controlling interest in net income, right? Okay, non-controlling interest in net income. So that is 7,500. So where do we get these two numbers? 67,500 and 7,500. From here. Okay, from the table. So it is 90% of net income and 10% of net income. Already we calculated that, and then those amounts here, 90% of net income and 10% of net income. All right? So, what about dividend? Dividend recorded as 100%, all. That was 20. And investment in Snoopy and non-controlling interest in net asset. Okay, those two, look, ending balances of investments in Snoopy and ending balance of non-controlling interest in net asset of Snoopy. Is that clear? Yes. Okay, do you understand how to prepare this table? Any number here? Okay, Sheikha, Duha, Maryam, Nadia, can you follow me? Do you have any question? Ragat, Reem, Zainab? Yeah. I hope it is clear. If you have any question, please ask. This is book value calculation table. And based on this table, we are preparing basic consolidation entry. Okay? So basic consolidation entry, what this stands for? Non-controlling interest in net income. So this together makes net income, you see? Total net income is 75,000, 90%, 10%. 90% is the income from Snoopy, 10% is non-controlling interest in net income. On the other hand, this investment, total investment actually here, 90% of it is here, 10% is here. Okay, if it was 80% ownership of parent, so we multiply everything but 80 and 20. That's clear, right? Good. So the other entry is, what is the other entry? Accumulate depreciation consolidation entry. So when we look at the table for Snoopy, right? We see accumulate depreciation is 20. Do you see that? But depreciation expense is 10. So how much do we eliminate? 10. Why? Because of depreciation expense 10? No. It's not answer. It's not because of depreciation expenses 10. Because beginning of the period, accumulated depreciation was 10. Now at the end it is 20, right? But 10,000 of it is recorded during this year. So if 10,000 increase in the amount, if we decrease this 20 by 10, it will be 10 at the beginning. For example, if the accumulated depreciation was 30 and the accumulated depreciation expense 10, the amount we will write was 20. All right? Yeah, difference. This is first year because of that difference. Because first year, okay, look, January 1 is the acquisition happened. December 31st, we have this information. What are we looking for? We are looking for the accumulated depreciation on January 1, at the beginning of the acquisition date, at the date of acquisition, at the beginning of the year. So that amount is calculated by deducting the depreciation expense of the year. If that year 10,000 increase in the depreciation, if we decrease it, we get the beginning balance, correct? Okay? So it's simple difference, but this is the first year. Be careful, Bella. If it is second year, we don't do like that. Why? Why? Second year, if we deduct depreciation expense, we get the end of first year. Do I need end of first year? No. I need one more year deducted. Do you understand? Okay, at the date of acquisition, it is 10, right? At the end of first year, it is 20. At the end of second year, it will be 30. So if you deduct 10 from 30, you will get 20, but 20 is not the date of acquisition. So that will not be correct for the second year.
So we take the
Beginning, this 10, 0 point.
Or do like 30 minus the 20.
20. But we don't have that information in trial balance. So if it is the second year, there should be some additional information. Look at the paragraph. It will say that if it is subsequent years, it will give an information. At the date of acquisition, the accumulated depreciation was this. Okay, take that number. Don't do this calculation. Okay, but if there is no information below and it is the first year, you can do it like this. 20 minus 10, you get 10. Okay? All right. So here, based on that number, what we did, debit accumulated depreciation, credit building and equipment. You see, this is netted. It is actually no increase or decrease in total. Just we are writing two sides, so we decrease both, so total asset will not change. So sometimes they call it, this is optional, but we are doing if we have information. So you see, acquisition of the the investment is 270, net income added, dividend deducted. This was the ending balance, and then when we record this 319 500 as credit, this is what is this basic consolidation entry? It will be 0. You see, investment increase, decrease, and this is the ending balance of investment. This highlighted one is the elimination entry, basic consolidation entry. The ending balance will be 0. So let's look at the consolidation. What do we have here? Basic. Okay, this is basic consolidation entry. This is accumulated depreciation entry, and these are reflected to consolidation worksheet. So what do we have in the worksheet? We have parents amounts, subsidiaries amounts, 2 column for consolidation entries, and 1 column for consolidated balance. So in the assignment, I leave these empty. You will also prepare income statement and balance sheet. Sorry? Debit and credit is for only entries. This Peanut and Snoopy, there is no debit credit here. In the tables, in the balance sheet or income statement, we don't have debit credit, right? If you have debit credit, it is trial balance. So from trial balance, you are posting the numbers. Yes. Yes, that's right. You are seeing that. Okay. Consolidation entries, we have debit and credit columns. So these debits comes here, credits comes here. Clear? Do you have another question? I didn't get it. Could you repeat your question?
No.
It's clear. Good. So here these amounts will come here. Okay. So the highlighted ones are from the entries. Okay. When we look at the statement, right? Let me show it like this. Okay. Let's start with the income statement. What do you see in the income statement? You see sales minus cost of goods sold, minus depreciation, others, and plus income from Snoopy, we get the consolidated net income. Actually, this is not classified. We don't have gross margin here. We don't have operating income. This is just as listed. It's not classified income statement, okay? But we have revenues and expenses, and net amount is 392,500. Snoopy's income statement is here. Okay. Net income is 75. A few minutes ago, we calculated that, remember? 75,000 is the net income of Snoopy subsidiary. So, the consolidated amount, 800 plus 250, it is 1,050,000. When we look at the cost of goods sold, 200 plus 125, it is 325, but it's at a minus, right? Both of them minus. and depreciation expense, other expenses. Other expense here is the selling and administrative expense actually. So income from Snoopy is eliminated because in the consolidation entry we have this, you see 67,500 debit entry. So it is posted here. So income from Snoopy is 0. So in consolidation, income from Snoopy, income from subsidiary in general must be 0. We have to eliminate income from subsidiary. Okay? So, and then consolidated net income here 400,000. But consolidated net income is not same as the parent's net income. Previously I was saying consolidated income equals to parent, but here is not. Why? It is?
19.
It is, okay, this is all 100, but we have 90% of it. So not only this 90 of this, it is subsidiaries part will be 90. Yes, Fetcher, thank you very much. Because of non-controlling interest. We have to exclude the non-controlling interest share in the income, and then we get the remaining balance, that will be our. Okay, look, non-controlling interest net income, as you see, is shown as debit entry, what we did here, you see, 7,500. So this 7,500 will be minus, so controlling interest of net income will be 392,500, that is same as parent. Now it's same, right? So we have two net income here. One, consolidated net income, including non-control interest, and after non-controlling interest, we have controlling interest. Okay, controlling interest means parent share, right? Controlling interest, 90% of. Yes, clear? Any question? All right, this is income statement. So these two numbers, 75 and 0, comes here. And then retained earnings, beginning balance, here what we did in the entry, retained earnings 100, you see. And dividend 20, they are all coming here, 120. From where? From basic consolidation entry. And then net income 75 added, so ending balance 175. Dividend 0, 20, total 20. Okay? So retained earnings 225 plus 100 minus 100, it is 225. So why is this minus? I said minus. Why I deducted? Because it is debit entry, right? And retained earnings is a stockholder security account, and the balance of retained earnings is credit. So if retained earnings balance is credit, if I do debit entry, it is deducted. Okay? So by the way, this 225, same as the parent's amount. Okay? And then net income, look, 392,500 plus 75 minus 75, we get 392,500. So it is again same as parent. So we are eliminating all the amounts relating to subsidiary, and as a result, we have consolidated balance of, consolidated statement, same as the parent's amount. These are the consolidated retained earnings amounts, and same as the parent. Yes, any question about retained earnings? Any number, how we calculate, how we did the calculations? All right, let me go on then. Which statement next? Balance sheet. Now, ending balance of retained earnings, okay, this 175.20. First of all, I will shift them here, you see? This 175.20 will come here, okay? This is not from the entry. This is from this, because these statements are connected, right? Articulated. Now, the ending balance coming here. Sorry? Yes. Yeah, ending balance of retained earnings. Now in the balance sheet, when you are doing in the financial accounting class, you did it, remember? First income statement, that income taken to retained earnings statement, ending retained earnings goes to balance sheet. This is the, the connection between tables. Now, when we look at the cash, simple total. Account receivable total. Inventory total 200 plus 75, 275. Clear, right? Because there is no debit credit. In chapter 3 and not we have 3, chapter 4 and 5, we have some entries about inventory because there is some excess value, fair value differences. Later we will discuss. But now we don't have anything about other assets. All are same, so we get calculation of the total. And then investment in Snoopy, look, we credited this amount, remember? So it is 0. So for example, if you made a mistake, when you are calculating the investment in the book value calculation table, you didn't multiply by 90, you multiply by 80, and this amount will be not same. So it will not be 0. So you go back and correct it because the ending balance in the book value calculation should be same as the investment here. If you didn't get this number, it means you made a mistake. Okay? You can check and correct. So investment in Snoopy, 0, eliminated. It must be eliminated, isn't it? It must be eliminated always. And then land, 300. Building and equipment, look, 10,000 eliminated. So 700 plus 200 minus 10. Okay? 700 plus 200 minus 10. Why? Because this is an asset. Asset has debit balance. The entry is credit entry. So 10,000 will be a deduction, is reduced from the total. Accumulated depreciation has credit balance. So the debit entry means a deduction. So 450 plus 20 minus 10 equals to 460. So as you see, total amount of asset is written here. This is the total assets. When we look at the stockholders equity part, what do you see here? Accounts payable, bonds payable are total. Common stock, do you remember this 200? From here. Common stock debited by 200. Retained earnings debited by 100, but here it is 175 and 20. Why it is not 100 here? Retained earnings was 100. Common stock was 200. Common stock written here 200, but it's not 100. Why? Fatma, why? No, it's not about that.
You take the ending balance.
Yes, exactly. That's the answer. Actually, that 100 already we recorded here. Okay, beginning balance, because that in the basic consolidation entry, $100 beginning balance is eliminated, but that is recorded in the retained earnings. So these amounts are not taken from the entry. These amounts should be taken from ending balance. Okay, because of that. You got it? All right. So be careful. The typical mistake, somebody writing here 100. So that's a mistake. Don't do it. 100 should be written where? Here. Okay? The beginning balance. So let me go on. Look, retained earnings. We took these two numbers, right? So 517,500 plus 155. 175 will be plus or minus? Minus. Why?
We will deduct.
Yes, why?
Because it was credits and we make
Exactly. Great. Now you get it. You get the point. So the retained earnings has credit balance, right? Because this is stockholders' equity. Whenever we do debit, we deduct. Okay, so 175 minus deducted, 20 will be added because this is credit. So the amount will be this. Okay. So anyway, you can do this calculation. You will get this number. If this number is same as the parent, then you are on the correct way. If it is not same, it means you made mistake somewhere. You go back and check. I'm just clearly saying the common stock and retained earnings must be same as the parent's number. If parent's number is 500, 517 is 500, so these two numbers should be there. Okay? And don't miss another account. This is a typical mistake. Somebody is missing this account, non-controlling interest. Don't miss it because it is already in the basic consolidation entry, non-controlling interest net asset. So this non-controlling interest in net asset is in the balance sheet. Not non-controlling interest in net income is in the income statement. Okay? One is in the income statement, the other is in the balance sheet. So be careful. That should be there. So when we are preparing the net income statement, you see this one, and also here you see this one. Non-controlling interest in net asset of Snoopy, 35,500 will be okay. In addition to the stockholder security, look, that amount is credited, right? So credit balance in the stockholder security shown as a plus, not minus, not a deduction. It is there an addition. So if I ask you how much is the total stockholders equity, how much is the total stockholders equity of consolidated balance sheet, you should tell me these three of them, okay? Don't forget adding this non-controlling interest in net asset. That's another typical mistake. Someone is missing adding to this, only common stock and retained earnings. No, non-controlling interest is also a part of stockholders equity, right? Okay, so this is the how we do the consolidation worksheet. Do you have any question? Clear. Good, thank you. So we posted these entries first to the worksheet, and then we add deduct and we find the final balances. At the end, you should be careful. Total assets and total liabilities and equity must be equal. That's another typical mistake. You finish everything, but these two numbers are not equal, so there was a mistake in that case. All right, this is the consolidation worksheet for the companies has some non-controlling share. There is another question, maybe later when we if we have time, let me decide. Maybe I will solve it or not. But I will now, we have 15 minutes. I want to solve a shorter one. This one. Remember last time I just very shortly showed the beginning part. Okay, do you remember this question? Sorry. Peace Computer Corporation acquired 75% of Symbol Company, okay, by issuing bonds. Par value 50, fair value 67,500 in exchange of the 75% of those shares. So, what is the acquisition entry? Do you remember? Debit investment, credit,
Cash.
not cash.
Here we have
Bonds payable.
Yes.
So if there is bonds. So debit investment, credit bonds payable. But bonds payable may have premium or discount. So if the fair value of the bonds is higher, we have to write premium. So what is the value of this investment? Is it face value or fair value of the bond? Fair value of the bond, right? Market value. If you can trade this bond at 67,500 in the market, that is the value of that bond that we pay. So the investment will be 50 or 67,500. 67,500. Okay. So the entry debit investment, okay, debit investment 67,500, credit bonds payable What is this? Par value, right? Par value. I mean, this is written value, face value of the bond. Okay, 50. But the market value of bond is more than that. So if it is more, it should be premium on bonds. For example, if the market value is less, let's say 45, so 5,000 will be discount and it will be written on the left side, debit side. And then the investment will be 45, not 50. Okay? Clear? Good. So this is the how we buy using the bonds. And then book value calculation table. How do we have net income dividend here in this question? No, because this is only date of acquisition. Okay? So common stock common stock and retained earnings of the subsidiary 50 and 40. You see here 50 and 40. So that 50 and 40 here 50,000 common stock, 40,000 retained earnings. Okay. On the other hand, Dua, you see there are two columns. Why we do it? Because we have how many percent of ownership? 75. Good. So remaining, how much? 25. So 100. If 75 is the parent, 25 is the non-controlling. Good. So how do we get this 67,500? Together of this 90, we multiply it by 75 and 25. Okay. 90,000 times 75, it is 67,500. 90,000 times 25, it is 22,500. Okay. So we get 75 and 25% of the right side. Clear? Good. So, and then basic consolidation entry. Debit common stock, debit retained earnings. Here, no income or non-controlling interest because this is date of acquisition, right? This state there is no income or dividend. Only we have non-controlling interest, net asset, not net income. Okay, so debit common stock 50, debit retained earnings 40, credit investment 67,500, credit non-controlling interest in net asset 22,500. Okay, this is simple. When we solve the other one, this looks like very easy, right? Sorry. And the consolidation entry. Since this is date of acquisition, very simply, we do like this. Assets, okay, and then we have investment in the previous one. Sorry, something. So, in the question, 200 and 400, you see? Here also 200 and 400. But this is added. Why? Because this was, okay, acquisition done on January 2. The balance sheet is just before the acquisition. Just before. Since it is before, there is no investment here. So we add the investment here in the balance sheet of P's. But on the other hand, this 67 is shown here, bonds payable and bonds premium. You see, these are added because that table was before the acquisition. Remember in 5.7, I think, previous question, we paid cash. So what we did, we decreased cash and increased investment, remember? Now here investment increased, but liability increased because it is by bonds. Okay, and the subsidiary here and the debit credit entries, and as you see here, the consolidated in the consolidated income statement, investment is 0. Common stock retained earnings same as parent, and we have non-controlling interest here 22,500. When we prepare the the consolidated balance sheet, also non-controlling interest is appearing here. Okay, I think this is clear, right? Good. So, yes, let me share you one thing. What is this? What is this? This is the project. So, Facebook, Instagram, Disney, Pixar, Google, YouTube, Facebook, WhatsApp are taken.
Group number 7.
Yes?
I sent you an email
When?
yesterday at 6.
I didn't check in the morning. Which topic you want?
Number 5, Apple and
Shazam?
no.
Beats?
Yeah.
Apple and Beats. Okay, good. Thank you. So now I am giving this topic to them. Group 7. Oh, I couldn't. The computer doesn't want to give it. Do you want another one? Okay, now you have one topic. Thank you, Rukia. And anybody here? Faye, Gufran, Shireen, Maryam, Aisha. Which one do you want? Which topic? Just tell me, or I will give you one. Okay, have you discussed? Okay. Fatma, Haya, Husa, Jana. Have you decided on topic? Or I will give one. Dalal?
Not yet.
Okay, in 5 minutes you will have one. If you don't decide.
I will decide. I don't want to.
You have to already, but now I will give you one. In 5 minutes I will give one. Lulva, Fajr, Duha, they are not here. So, do you want to choose one or I'm now giving a topic? Okay. Okay, I will decide for you, don't worry. Facebook is taken, Facebook, WhatsApp taken, Google, YouTube taken, right? So, Amazon Souk. Yes, Faye, Gufran, Shirin. You have Amazon Souk. Okay, noted.
I want Apple and Shazam.
Apple Shazam? Okay, Apple Shazam Group 2. Okay? Fatma, Haya, Sakabi, Jana. You now having Disney. Okay, Disney Pixar. Already taken. So you should take Disney 21st Century. Okay, Haya. Disney 21st Century. Is that okay? Good. So, Dalal.
Microsoft and LinkedIn.
Microsoft LinkedIn. You see how easy choosing it. Why you waited so long? Okay, Lulva Fajr Duha. Okay, I'm giving a topic. This one. What was it? Amazon Souk. Let's choose another one, and a local one. Or MBK Bibian, maybe. Maybe another local one. That is all right. This old one. Bibian already old. The Souk is good. Okay. Now, Lulva Fajr Duha. You have Amazon Souk. Dalal, Microsoft LinkedIn, Apple Beats Rukiye, Fatma Haya, Disney 21st Century, Faye Gufran, you have Apple Shazam. Yes, that's all. Now, Solved another issue. That's good. So, do you have any question, any contribution? All right. Please start doing this project. In the project, I want something original. Like what? Some numbers, some facts. When you are explaining this merger or acquisition case, you have to bring, a good presentation. When we listen it, we should get these answers. First, why this company acquired this company? Why Apple acquired Shazam, Beats? Why? And how? How much they paid? How long it took? How many percent they acquired? And then what is the result? Is this a successful acquisition or not? If it is successful, prove it. Okay, revenue increase, number of units sold increase, or they did some reorganization, improve their product, they make investment. You give some facts, figures, and here, now we are discussing here, let's say P is and symbol, peanut and software something. But now actually you will see when you discuss your case, we will see a real example, real merger and acquisitions. So based on that, you will also see their financial statement, you will see their reports, annual reports, you will discuss about their, activities. So what happens? You will really be familiar about a merger and acquisition case. When you are searching it, you can search some academic articles, but not only that. In our library, catalog, these databases, we have some, information, some data about, business activities. So let's say Episco, they have some business source premium databases. There are others. So when you search in total, you can find some very good figures, discussions, reports, analysis. For example, a big investing house make an analysis about this merger. That will help you because in a professional eye, you will see how the people see this investment, how they see this acquisition. Even before acquisition, they prepare some report. After that, they 1 year, 2 years later, they make a report. Is this acquisition was successful or not? They are discussing. So it is better you to reach some real discussions, real data, real information. It will help you a lot. Okay, these projects will add you a lot if you do it well. Of course, you have to be familiar about the project because you will present here. If you are 4 members, 4 of you must know everything about the project you prepared. When you come to presentation, I will ask you any question. So you don't say that, okay, this is not my part. I didn't prepare this portion. I didn't write it. No. You are responsible from the first page to last page. Everyone. Anywhere in the project, I will ask you. So all of the members should be aware about all mergers. Okay? You don't say, I only write the conclusion. Okay, I just make an inquiry. No, I hear this. I'm just familiar with kind of excuses. This was again